there's other things is just gifting assets. One of those ways is often your kids have a lower tax bracket than you're in. So, they can sell that stock at, maybe zero or at least a 15% tax bracket, and then you might be in the 20% capital gains bracket. Welcome to Wealth Creator Radio, where we help people overcome the uncertainty of having enough retirement income. I'm your host, Eric Heckman, a certified financial planner with over 30 years of experience. We want you to enjoy life and not have to wonder where your money will come from and how long it'll last. My mission is to show you how to develop a personalized income plan so you can retire more and have worry less wealth. Here at Wealth Creator Radio, we cut through the noise and get straight to what matters. We understand that the world of retirement planning can be filled with confusing products, ever-changing tax laws, and volatile markets. That's why we're here to help successful people like you navigate the uncertainty and create a blueprint for a thriving work-optional life.
Pillars are a classic feature of architecture. I think we can all think of one or two well-known structures with those solid columns, out in front. And you think about, well, what would happen if one of them toppled down, right? The whole thing might come down. Well, it's the same for retirement. We're going to get into that here in just a minute. Thank you for joining us today. You are listening to Wealth Creator Radio with Eric Heckman. I'm Lou Ann Fulmer. Eric is a certified financial planner. He's been helping people like you have remarkable retirements for over 30 years now. And it's Eric's mission and his team's mission to help you plan for lifetime income, to help you weather almost any economic storm that happens throughout your retirement. Call or text the word visit to 800-454-1184. The appointment is complimentary. Remember, you can get that digital toolbox as well. We'll be talking about that. Listen for your chance to text the word toolbox to 800-454-1184. It includes the books that Eric has written. And our podcast comes out every Tuesday morning. So wherever you listen to podcasts or on YouTube, search for Wealth Creator Radio. And Eric, hello to you. So excited to be here with you.
Yeah, Luann, it's always good to kind of get back to the basics and, talk about those main pillars of retirement and what the main things that people need to be thinking about, because sometimes we get distracted with all the shiny objects or whatever you want to call it, right? So sometimes just going back to the fundamentals is good.
Right. So looking at the St. Joseph Basilica, and the pillars there, I mean, such beautiful architecture and old, and it really does matter, I think, if something would happen to one of those structures, it would affect, the entire building, right?
Yeah. So, anytime you're talking about those structural pillars, those things that hold up the whole thing, right? That's kind of can be related to retirement income. And, retirement income, there's a couple different things you want to look for. And, you never get all of these things in one product. So it's more about a combination of all these things, right? So one is protection, right? You don't want to be retired and have another 08, 09 meltdown and boom, half your money goes away, right?
Right.
But you're going to hopefully be retired for 30 plus years. So you also still need that growth. You still need some of that money growing to combat inflation and, have that money getting bigger. Of course, the only thing you have to have in retirement is income, because otherwise you're just unemployed, right?
Yeah.
So you have to have some income. Some of that stuff has to be not just going up in value, but it has to actually be paying dividends, interest, something that you can withdraw, right, on a monthly basis. And then you need some of that money liquid, because the fridge dies, the roof needs to be repaired, fence blows over, whatever junk happens, right? Life happens. You need some money that's going to be something that you can go grab, in those times where you need that money.
Liquid money, right? Yeah.
Yep.
So tell us the kind of risk you're exposed to if you do not have a 4-pillar retirement like you just mentioned.
Well, if you just think about the 401k is pretty much it's all stocks and bonds. So I call that all market money. So that's all growth potential stuff. It has zero protection. There's usually no options in there to protect yourself from, the values dropping. You might have a money market or something like that. That might be a little bit, but, really not anything. When I look at most people's, their portfolios, the average dividend yield, so and how much the interest and dividends pay, is almost always 1.5%. It's super rare if I ever see anybody over 2, and usually most people are at least at 1. So it's really somewhere in the ones.
Okay.
And so if you need 4 or 5% out of your portfolio in retirement, and you're only getting one, from dividends and interest, that means you're having to sell shares every single month to get by. And so then, if the market drops that month, you've now locked in those losses. If it drops again, you're locking in even more and more, right? So that's kind of the big risk that you run is when's that downturn? When you're selling shares, the market never goes up straight line, right? It's always all over the place. And so, you're potentially losing a lot because of you don't have some of that money protected and you don't have anything set up for income. I mean, you might have liquidity in like a bank account and stuff, but usually for most of the investments, they can be liquid, but liquid if the market goes down is not so good, right? You want some money that's protected where it won't go down. So that's the biggest risk I find most people run into in retirement.
Okay. Eric, let's talk about then that protection part of our retirement plan. What are we protecting our money from?
Good question. Protecting it from loss, right? Protecting it from it going away. So there are some great tools out there. Ones from insurance companies where they'll pay you a rate based on the stock market. I like to use these in place of bonds. So, a lot of these, they can pay, say, 10% if the market goes up 10%. And so what they do is look 1 year later and how much did the S&P 500 change? If it's anywhere from 0 to 10, you get that number. If it's more than 10, well, all you get is 10. But if it's negative anything, you get 0. You don't lose a dime. And you get to start off at a lower, point in the index. So there's, a lot of higher odds that next year of you getting that 10%. So those can be really good because you can take money out of those. Usually most of them let you take out 10% a year. So you could be doing your withdrawals from there, especially when the market's down. That's where you want to take the money from, something that didn't lose money, right?
Right.
And then when the market goes back up, then you can decide which way you want to take the money from. But, those over time should average 5 to 9% or so. So a lot better in bonds with zero risk. And so, that's a good, easy way to learn more about how to protect your money. And so one of the things that we also have is we're very big about education here. So we've got a digital toolbox that has a couple different things that you read, like, will I outlive my money, which you don't want to do. What's the correct timing for Social Security? Are you paying too much money in taxes in retirement? Copy my book, Worry Less Wealth, and even a way to set a time to talk with me, Eric Heckman. So if you want to get access to that, super easy. We'll send you the link. All you got to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or go online and download it directly at wealthcreatorradio.com.
And you're listening to Wealth Creator Radio with Eric Heckman of Heckman Financial. I'm Lou Ann Fulmer. All right, let's talk about growth potential. Obviously, we need our money to grow. That's our income in retirement. I think immediately, though, our minds go to investments when we think about growing our money. Is there a way to grow it without investing in the markets, Eric?
Well, I mean, like the index annuity type stuff that we mentioned, that's one option that can grow pretty good and still earn some good interest. There's some alternative investments that are actually investments, but they're not maybe daily traded in the markets. And, a lot of those things like private equity, real estate, other things, those can give you some good growth and, without as much of the volatility up and down. So, it's always, again, it goes back to that, that 4-letter word plan. If you get a plan, then this can all work out. But if you're just kind of doing it by just whatever you see that day or whatever sounds good on the radio or on the TV, that's not really a great way to do it. You want to have a plan.
Another pillar that we were talking about for a sturdy retirement would be income. And that kind of, is a pillar that supports really every other pillar. Where do people get their income in retirement from?
Well, most only have Social Security and rarely have a pension. So really they're just getting their income from whatever dividends. And like I said before, they don't get much. So they're usually having to sell assets all the time. So that's a very overlooked area of designing some money that has some super high income. That's what we always have what I like to call steady income section, where we put 10 or 20% into things that pay a lot of income. So that way you don't have to sell as many shares. You got some cash flow building up.
Love it. And then the fourth pillar, liquidity. Again, talk about why that's so important.
Yeah, well, you always want to have that. My sons were scouts. I was a scout, and my youngest made Eagle. And you want to be prepared, like the scouts say. So you want to have that be prepared fund that allows you to have some money that usually about 6 months of expenses. So that way you can go pay for that new fridge, pay for whatever home repair, whatever comes up. So again, we can get a lot more data and a lot more stuff to read and educate yourself. Some really quick things to read and review, but not stuff that takes a ton of time. So the easiest way to do that is just by texting the word toolbox to 800-454-1184. Again, text word toolbox 800-454-1184 or download directly at wealthcreatorradio.com.
Do you know whether your retirement plan has any weak points? Discover ways on giving your financial future the proper tune-up. Simply go online to wealthcreatortoolbox.com to gain a better understanding in taxes, Social Security, and other ways to manage your portfolio. That's wealthcreatortoolbox.com.
Hey, thank you for joining us today. I'm Lou Ann Fulmer here with Eric Heckman. And whether you've built, a business, invested in stocks, owned real estate, maybe you're going to inherit some assets like these here, there can be some costly challenges waiting. And when you sell an appreciated asset, something, far worth more than you paid for it, then you could potentially lose 30 to 40% of taxes in a single year. So that's what we're going to talk about right now. I thought that'd be really important. Eric, what are some of the biggest tax mistakes that people make when they're trying to sell these appreciated assets? And then why could traditional approaches leave so much money on the table?
Yeah, well, lots of times people just kind of do it and then try to plan. So, that's one big issue because there's a lot of things that, that you can do to avoid some of these taxes. But the problem is if you don't do that, a lot of them, you need to do something before you sell the asset. So if you've already sold it, then a lot of your options go away. So, there's things like charitable remainder trusts and donating some of these things to get it write-offs and other, lots of different things. If you're talking about real estate, there's specialty things like 1031. And so there's all these things, but, really the biggest problem is just not taking the time to say, oh, I'm about to sell this. How's it going to affect everything? How's it going to affect me this year, next year? If you're on Medicare, that may jack up your premiums in 2 years. There's all these little gotchas that, people just don't sit down and take the time to figure it out. And then they try to figure it out in April and it's like, yeah, too late, right? Because most of the stuff you could have done is already over and done with. And, so yeah, I'd say the first thing is know what the tax hit is before you sell and then start getting advice on it. But, if it's something like you had to sell really quickly or something which is not usually as typical, yeah, maybe you have to do it, whatever, then at least get some help as soon as you can afterwards.
Right. So obviously, planning before the sale is critical. And, this is what you guys do at Heckman Financial. You work with taxes. So you do this a lot. So you've seen this. And if someone is sitting on, highly appreciated stock from a company or maybe their investment property has tripled in value, maybe they're thinking about selling their business, why don't you give us some strategies that could maybe help people? Instead of handing that money over to the IRS, how do you help them save money?
Yeah. So, there can be stuff like for businesses and even real estate, you can do installment sales where you sell it over a period of time and then that spreads that tax hit over. And why is that important? Well, you don't hit those super evil upper brackets then, you avoid some of those high brackets. So, if you could spread the tax hit over, say, 3 years versus one, that can save you a lot of money. Charitable remainder trust, like I mentioned before, these are ways where you can donate part of that before you sell it, get a write-off, and then that write-off gets you helps you pay the tax bill, helps you offset it, and then you also end up getting a lifetime income out of it. So, there's a lot of benefits all around for those. 1031s for real estate, lots of times people think they have to go own more real estate. Well, you can actually buy other types of things where you're a passive person owning it and somebody else is running it, managing it, and you just get the checks. So there's a lot of good options there if you're trying to get out of being a landlord. And then opportunity zones, these are things where you can defer gains. They're a little bit more complicated. But also if you're lucky enough to have a special type of stock, that is for small businesses. I have a client right now who he worked there long enough, and his company got bought, and so yeah, he's able to sell like several $1 million of stock tax free, which is just crazy.
Yeah. Oh,
so
yeah.
so that's a wonderful option, and there's even things like oil and gas drilling and other stuff that give you a last minute deductions. So there's lots of options, but yeah, it's one of these things where again you got to get the advice early, not wait till April.
Exactly. So I want to get into that charitable remainder trust because that sounds really almost too good to be true. And so talk about that, how people could potentially get an immediate tax deduction.
Yeah, we use this a lot for for people, especially with like company stocks. So if they at a company that they've been there for a while and the stock's had a huge run up, say it's Nvidia, Google, Facebook, whoever, there's lots of times they have a lot of stock sitting there and they want to get out of some of it, and they've got a lot of risk having one company. And so what you can do is you can take a big chunk of it, say maybe take a third, put it in a charitable remainder trust. You get a big upfront tax write off for that. You can then sell off a bunch more stock. And then that charitable remainder trust at some point turns into a lifetime income. So when you then go to retire, you can get income from it. The only caveat is reason they call it remainder is the charity gets what's left over. So, once say if you're married, once you and your spouse both pass away, your kids do not get what's left over. Sorry, kids. They get the house, they get everything else,
Yeah. Yeah.
but they don't get this asset, and that's the charitable function part of it.
Okay.
And then, but again, that's usually probably fine because you got a good write off, you got some good benefits out of that for that long period of time, and so yeah, no, it can be a great way to build up some money and have some access to to getting your money without having all those huge tax hits. So, again, that's what it's all about. And, really that's why we're here. So, one of the things we've developed is actually a toolkit for people. So it's a digital toolkit where you have stuff like, will my money last as long as I do? Am I spending too much in retirement? Social security timing decisions, even a copy of my book, Worry Less Wealth. So if you want access to all that and even set a time to meet with me, Eric Heckman, all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below if you're watching online.
And we thank you so much for joining us today. I'm Luann Fulmer here with Eric Heckman. And all these strategies that we're talking about seem so powerful, but I would imagine that timing and structure are everything, just like you're saying. You can't wait till April. You've got to do, to try to take advantage of it that year. You have to do it before the year end. So for anybody watching or listening who's considering selling an appreciated asset, whether it's next month or next year, tell us about the kind of analysis that you would do on them to help them understand which strategies would help them best as far as taxes go.
Yeah. I mean, first of all, of course, you have to just learn what their situation is, right? Are they still working or not? Or are they about to retire? Because sometimes people are selling their house and retiring and doing all this crazy stuff all at once. So there may be an avalanche of tax issues. So so sometimes it might be, well, let's see, can you sell the house the next year, right?
Yeah.
And
Yeah.
so yeah, knowing what that tax hit will be in the year you think you're going to sell it. I mean, I did recently meet with somebody who was planning on not selling till the next year, but they wanted to again get that information ahead of time and start planning this out. So that's why once they did pull the trigger to say, yeah, we're going to sell it, that's really smart. I mean, it's really good planning to plan that far out, and know what it's going to be like and know your options. So yeah, I would say try to get that stuff early, especially if you're talking about something that's like with a trust or something like that. Then you have to have legal documents drawn up. There's timelines, there's things like that. So yeah, definitely try to get this going a little bit ahead of time. Ideally like 2 or 3 months, or even maybe more before you're gonna do it, and especially if it's near the end of the year. Sometimes, yeah, you can do special things like, sometimes you say, well, can you, if it's a stock issue, maybe you sell off half this year and half next year. That alone can split the tax cost down by a lot.
Right. So yeah, all these things you're telling us seem very complex. They have a lot of specific rules and requirements. So again, I just reiterate how you help your clients navigate these options and implement them correctly so they can avoid any costly mistakes with the IRS.
Yeah, well, really, it's all part of a plan. And once we have the plan, look at where you're going, what you're trying to achieve, then it's easy inside an income plan. But yeah, that's the biggest key. So, again, that if you want to have access to that toolkit and get a lot more information, we're here to help you learn more. So all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Hi there. I'm Luann Fulmer here with Eric Heckman of Heckman Financial, where their mission is to get you to and through a worry-less wealth retirement. Trump signed the One Big Beautiful Bill into law. And so what it did was, it made the higher estate tax exemptions permanent. But, we know that permanent only lasts until, the next Congress decides to change it. So you can't really call it permanent. But Eric, given this uncertainty and the reality that estate taxes can be such a significant cost, what strategies should people consider right now to try to help protect their assets, regardless of any future political changes?
Yeah, well, one of the problems with all these tax stuff is nobody's paying our bills. U.S. is not paying our bills, right? So that tax bill added another $3.5 trillion to the debt. So that was, it's like, here's a pay raise because we got a new credit card. That's not how life really works. That's not how you should be thinking. So some point things will have to change, because at some point we're just going to have to pay our bills. So you can kind of count on taxes at some point having to go up. And so, one of the things that, you can look at is state taxes. If you're over those limits, now traditionally they usually have gone up and not gone back down hugely, but they could. And so, so making sure that you have a trust set up, making sure you've done some planning. You can be doing that gifting, you can do $19,000 a year per person of gifting. And, so there's lots of different things that you can do if you're getting close to those strategies, and, just really making sure that you have it all set up in the right way, and just making sure you have just all your documents, right? Having sure everything's going to the right people. You've checked your beneficiaries. You've got secondary beneficiaries. So, a lot of stuff's pretty basic, but it's amazing how people don't even do that part.
Yeah.
So
that 40% tax rate on amounts over exemption versus 20% capital gains. I want to talk about that, because that's kind of brutal, especially when the tax bill comes due in just 9 months. But the family's wealth is then locked in, right? And it's tough for them to sell. What are some strategies they should consider to help protect the family wealth and help ensure that more is going to go to their heirs rather than the IRS?
Yeah, there's special trusts like grantor trusts that move the appreciation out of the estate. So if you're lucky enough to have a $20-30 million estate, these are things that you really should be looking at, because you're going to have issues, right? So I think for people under 5 or 10 million, they're going to probably be safe, but over that might be the bigger line. There's other things, is just gifting assets. One of those ways is often your kids have a lower tax bracket than you're in, so they can sell that stock at maybe 0 or at least a 15% tax bracket. And then you might be in the 20% capital gains bracket. So, there's some natural savings right there. One of the big things that people kind of don't understand as much is if you own life insurance and you put it in a special trust that's outside of your estate, you can give a lot of money away tax-free and just have the government out of the picture totally. So, there's lots of different options. It's just a matter of having somebody who knows what they're doing tax-wise and has that expertise, or at least has access to some high-end planning techniques. So, a lot of times we'll bring in a couple specialists that we have access to that have every single designation and degree that you can imagine. And so, they'll give us, here's the best options, for that situation. Cause sometimes it is very specific for each person.
Right. I remember my dad did gift my sisters and I money while he was still living. And that was wonderful. We were able to use that. We each, had bought a house. And so we were able to use that for our new houses. It was wonderful. Yeah. So, a lot of confident savers have done exactly what they were supposed to do, maxed out those 401ks and their IRAs, but the harsh reality is those $1 million plus IRA balances are becoming a tax time bomb for their heirs. So explain that, why large IRAs, you kind of already touched on that, can be a huge problem for families, and just more strategies on what they can do to diffuse that situation.
Yeah. So, if you own stock, house, anything like that, when you pass away, your kids get a step up in basis, meaning they pay no tax on any of the gain. Now, again, there's the estate tax, which we were just talking about. That's when you're, up over the 10, 15, $20 million levels. Right. They might have some estate tax, but normally for most people there's no tax at all. With those big IRA bounces and 401k bounces, not only is they a nightmare for you to have because that's a ton of tax to pay, but when it goes to the next generation, they have 10 years to take all that money out and pay all that tax. And more than likely, when they get this, hopefully for you, right, you're a lot older and they're older. And so they might be in their 50s when they inherit this money, making good money. And now they've got 10 years to have this huge tax bill on top of their normal tax rate. So, I always say it's better to have a tax problem than a no money problem. So still,
exactly.
Still not a bad thing to have, but yeah, it is pretty ugly, that tax hit. So again, that's why we set up that toolbox, that digital toolbox for people saying, there's really quick reads like, am I paying too much money in taxes in retirement? Will my money last as long as I do? Social Security timing decision. A copy of my book, Worry Less Wealth, and a way to set a time with me, Eric Heckman. So all you got to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below.
And this is Wealth Creator Radio. I am Lou Ann Fulmer here with Eric Heckman. So happy to have you along today. So, talking about the Roths, okay, for someone trying to determine if a Roth conversion is going to be right for them. Okay. Talk about, the kind of analysis that you guys do to help someone make this critical decision, because you have to pay taxes on those.
Yep. Yeah. You got to pay tax. It's pay me now or pay me later. Yeah. Right. And I usually kind of use the seesaw example. So, or teeter totter, depending where you grew up.
What do you call it? What do you guys, seesaw?
So, yeah. But, so if you're in the 10 or 12% bracket, no matter what, do those Roth conversions, because you will probably be, when you have those required minimum distributions, in the 22 or 24% bracket. If you're in the 37, well, no, it's pretty hard to do that, to pay the tax now if you're going to be in a lower bracket later on. So, that's when you don't want to do it. But the tougher one sometimes is if you're in a 22% bracket now and you're going to probably be in 22 at later on, it still makes sense to do it, because you may not have to take that money out. Like you may be 10 years away from your required minimum distribution. But if you have 10 years of that money growing tax-free, that's going to lower down your lifetime tax by a lot. So then it gets down to just a decision point of how much to convert. And again, that's where you don't want to go up into huge brackets. I met somebody at one of our live events. He said he did a $500,000 Roth conversion and he was single. I was just like, why would you go up so high? Do it over 5 years or 6 years. Why? He was trying to convert everything in 2. Yeah. And he was paying like the worst bracket you could pay. So, you don't want to go crazy on it. You do want to do it. So lots of times we're talking to clients and we're doing, sometimes $30,000 to $50,000 conversions. They're not huge ones, but they're maximizing that smaller tax bracket. And, that's really the big goal. So it's not going to solve the problem. You're going to still have some tax issues, but it's going to make it a lot less bad. And that's all about, sometimes that's about the only thing you can do is have it less bad, not, not cured, but at least less bad, tax problems. So, But again, that's why we set up that toolbox. So all you have to do is text the word toolbox to 800-454-1184. Again, text the word toolbox, 800-454-1184, or click the link below for all that great info. This is Eric Heckman. I'm excited to share a sneak peek of a movie I co-produced, The Psychology of Retirement.
Who are the baby boomers?
If I had to describe the baby boomer generation in one word, it would be independent.
To be honest, I have done zero preparations.
My number one fear about retirement is the future. 20 years from now. I just want enough money to be able to live.
The whole purpose of money is to give yourself a better life, not just for your money to pay your bills, but to reduce an amount of anxiety and uncertainty that you have in your life so that you can actually enjoy these years that you probably spent decades building up for.
To get your free link to the movie, text the word movie to 800-454-1184. That's movie, 800-454-1184.
Investment advisory and insurance services offered through Heckman Financial and Insurance Services, Inc., an SEC registered investment advisor. Hey, thanks so much for joining us today. I'm Luann Fulmer here with Eric Heckman. He is offering a chance to help you create a retirement strategy where you guys are going to look at your income, your investments, your tax strategies, healthcare plan, and legacy plan. You can get our toolbox, remember, at no cost just by texting the word toolbox, 800-454-1184. All right, so we are going to get to retirement questions right now on our show. And then I'll get to kind of a real quick lightning round of think fast questions, Eric, where I'm just going to give you one thing and you have to tell me what's on your mind, okay? So that'll be coming up here at the end of this segment. But first of all, a question that is on the minds of a lot of retirees is this: when should I start considering taking Social Security?
Well, I think most people really should be around the full retirement age, which for most of us right now is 67. There's a few people born before 1960. It's a couple months earlier.
That's me.
Yeah, but most people, it should be really 67. You can wait till 70. You make more money, but you also don't get the money. So it depends on when you retire, right? But but before that, it can be really hazardous because if you work and make money, you can give it back and have to pay it back and such. So. Yeah. Yep. So that's still usually should be the main goal for people,
okay.
At least full retirement age.
Full retirement age. Love it. Okay. What are the best ways for leaving an inheritance to my family?
You mean die? No, just kidding.
Well, die.
Yeah, you have to do that kind of first.
You got to do that first, unfortunately. Yeah.
Yeah. The worst assets to leave behind are IRA, 401ks, because of now, those have to be spent down over 10 years and all the taxes paid. And whereas if it's a brokerage account, if it's a house, stuff like that, they get to step up a basis. There's no taxes due on it. Even Roth accounts are tax-free to the next generation, but they do have to be cashed in within 10 years.
Wow, they do? Okay.
Yeah. So there's, those are some, it just depends on which assets that you have, obviously. The biggest tax-free way to do it and build up more assets is really with life insurance. So, and a lot of life insurance policies today actually give you some long-term care benefits. So, we're seeing actually more and more clients where we'll move some money into life insurance, even if they're in their 60s, because not only does it leave behind some money if everything goes kind of right and they just pass away, but if things go not as right and they need long-term care, they can use up that death benefit for covering those costs, which really helps out.
Yeah, I love that idea. The fact that life insurance or insurance companies are actually helping with long-term care. I love that. Okay. Another question that is on a lot of retirees' mind: what are some ways to reduce my taxes in retirement?
Yeah, well, so the crazy part is you hear a lot of stuff about people spending a ton of money for healthcare in retirement, but really the number one thing that people spend the most money on is taxes in retirement. That is the biggest cost item. And so that's a critical question that, most financial advisors say, go talk to your tax person. Your tax person says, talk to your financial advisor. And you look like you're watching a tennis match with your head going back and forth, right? So, that's not what it should be. That's why we're licensed and trained in taxes. And you really need to be planning this because it can be a huge make or break in your retirement. So if you're not doing some Roth conversions, you're not doing tax efficient investing or tax free investing, there's lots of different options out there. But when you're building up that plan and you're figuring out what you should be doing, hands down, a dollar per hour, the most lucrative planning you can ever do is actually tax planning.
Okay, very good. And of course, you and your team, that's all part of your toolbox that, or your blueprint to worryless wealth, I should say, that's in the toolbox that you take people through. And then finally, this question, what do you mean when you talk about having a retirement income plan?
Yeah, so that's super critical. And, can you imagine going on a hike out in the forest and you have no GPS, no map,
Oh,
no phone, and you're trying to get to some lake somewhere? you know,
yeah.
good luck, right? Maybe you get up on a hill, maybe you can see where the lake is, maybe. And then once you get there, good luck trying to even get back to your car, right? So the retirement income plan is your guide. It's your it's your navigation system in retirement, but it's something that also has to be updated every year because obviously spending happens, right? You do different things, market changes, dollar values change of accounts, and tax laws change, everything changes, right? So having that plan shows you, okay, yes, I can spend this much money for the rest of my life, and I'm gonna be good with inflation, taxes, everything calculated in. But we have to also update that every year because, like I said, things are changing. So yeah, I cannot imagine anybody doing retirement without that.
Mhm.
Sadly, though, one of the studies shows that up to about 80% or only 1 in 5, I guess is the positive way to say it, have a plan.
Wow,
4 and 5 don't, which is just insane.
insane.
Yeah. So, so that's very scary. That's that wandering in the forest, and good luck. So yeah, that's one of the things that we do here at Heckman Financial is we build that blueprint to worry less wealth, where we talk first and foremost about having that retirement income plan. Secondly, then, looking at that, look at how the money's invested, because once you go to retire, you have to change that investment, not for growth, but for money, right? For cash flow.
Yeah.
And then what's the tax ramifications of all those different accounts? Which bucket of money should you be grabbing first? What's the healthcare issues? Long-term care, Medicare, how are you going to get health insurance? And then lastly, like we talked about there, who gets your stuff after you're gone? So, those are the 5 areas of planning that people really need to have a plan. Well, they have a plan. They need to know what their plan is
Yes.
and have an intentional plan. And so that's what we do here at Ekman Financial. And if you want to set up a time to just talk on the phone for 15, 30 minutes with me, you can do that. All you have to do is text the word visit to 800-454-1184. Again, text the word visit 800-454-1184, or book directly online at wealthcreatorradio.com.
Yeah. What we're trying to do here is help transform your worries of retirement into confidence. That's Eric's goal for you. That's why he's here every single week. And goodness sakes, he's done this for over 30 years. So talk about wisdom that you can gain from someone who deals with retirees every single day. So we just thank you so much for spending part of your day with us today. This is Wealth Creator Radio. I'm Lou Ann Fulmer here with Eric Heckman of Heckman Financial. All right, so now we are going to take a couple minutes, go into this lightning round of questions so we can get to know you, Eric, just a little bit better. I'm going to give you a quick, topic or something, and I want you to just quickly answer as quick as you can. All right?
All right, sounds good.
Okay, here we go. First one, top news sources you check regularly.
Well, let's see. I still get my local Mercury News, emails,
Emails.
not the paper,
Okay.
and also Wall Street Journal.
Okay, got it. What book have you read more than once, Eric?
Oh, that's a good question. Let's see. Well, Think and Grow Rich is an old one that's a really good book, and actually Compound Effect by Darren Hardy I think is one of the best ones. And
Compound Effect.
Yeah, that one don't know if I count reading it twice. I read it, and then I've also done the audio. So
There you go. I think it counts. How many siblings do you have, Eric?
Not anymore, but I had a sister who lost her 20-year battle of leukemia a while back. But yep,
You had a sister, little sister, big sister?
older sister. yeah.
Older sister. Okay, I'm sorry, though. I'm very sorry. Favorite sport?
Well, to watch is Sharks hockey.
Yeah.
I guess as most people know, I do a lot of cycling. So that'd be the one I actually do. I
Yes.
guess the most is
Cycling.
usually try to ride about 4,000 miles a year. So
That's amazing. I love that. What was your first car?
It was a little Mazda hatchback, so
Aw.
GLC. Which
What color?
it was pretty ugly. It was actually like I don't know, some brown.
Oh, that's
you
funny.
know,
That's funny.
Yeah.
Cake or pie?
I'd actually say probably pie.
Ooh, what kind of
It's
pie?
hard. It's hard to get pies nowadays.
It is,
There's almost
yeah.
no place that sells them anymore.
Okay, my last question, because I'm gonna have to wrap it up. Most important thing you want your clients to know about you.
Well, I mean, one of the things I'm most proud of is I was able to take care of my dad for 20 years, for his 20 years of retirement, or 20 years after my mom passed away. They were retired for about 3 years before she passed away at 60, which was way early.
Way early.
You know, and so being able to take care of him is probably the best thing I was ever able to give my mom. And it's what I do for my clients. I mean, it's just ready to sit there and figure out, okay, how can we make sure this all happens? How can we make sure you stay on track and enjoy a worry less wealth retirement? So that's what we're here for. But yeah, if you got some questions, you want to learn a little bit more and you want to just ask me some questions, feel free. All you have to do is text the word VISIT to 800-454-1184. Again, text the word VISIT, 800-454-1184. Or book directly online at wealthcreatorradio.com.
Would you rather pay more or less in taxes? If you want to pay more, don't do anything. If you want to pay less, talk to Eric Heckman to see what's possible for you. 800-454-1184. That's 800-454-1184.
All right, we have come to the time in our show, Eric. I love this part. You give us a story about some retirees that you have helped. Today, you're going to do a wealth success story. It's always a great lesson, to see how things worked out for the best with retirees. So tell us what you have for us today, please.
Yeah, well, I guess talk about Scott and Alex here. So they've been clients for quite some time, and they'd already, before we met, had done a pretty good job of saving up a bunch. And, over the years, we just kept doing different planning. We were taking advantage of that mega backdoor Roth, where you can fund extra money into your 401k after tax basis and convert it. And so that was helping them build up a ton of money now in tax-free, along with the taxable money that they'd been building up over all the years, funding 401ks and IRAs and such. And, they were getting closer to retiring. And, what happens in Silicon Valley quite often happened, and unfortunately, to Scott there, and he got laid off. Very common, and definitely coming back around a lot more, it seems like now. And so I think kind of post-COVID, a lot of these places overstaffed, and now they're starting to go, okay, who do we really need?
Yeah.
In his case, they got rid of his entire department.
Oh,
so
my.
that was kind of brutal.
Yeah.
And he'd been there for quite some time. So, now the nice thing is that, they give you, most of these companies will give you some nice exit packages. So he did get, several months of pay and all that stuff, but still it was kind of planning on going for a few more years.
Aw.
And I see this a lot where people, they're supposedly not ageism. There's supposedly not issues like that. But, if you're being interviewed by somebody in a hoodie and sandals and you've got gray hair, they kind of know you're older, right? So,
Yeah.
and they're, especially if they're like, wow, you're older than my dad or something like that, not good. They're not saying that out loud, of course, right?
Right.
But mentally, they're probably saying stuff like that. And, and so that's one of the tougher things I find is a lot of people end up, getting retired before they planned on doing it. But the nice thing is when we're running the numbers for them that, they can be fine. They're kind of crazy also in the remodel of kind of like their dream retirement home. So it wasn't necessarily the best time. But, in some kind of silver linings part, well, when you're remodeling something, there's all these decisions, all these things to make. Well, now you're going to have time to go do those,
You'll
right?
be there, yeah.
Yeah, you'll be able to go see them and watch them and stuff. So, so that's one of those things that I think people, in terms of the moral of the story, is really, if you're 60 plus in Silicon Valley, you need to be, ready in case your job changes, right? In a forcibly manner, right? Where you don't have the option. And, and I've seen it so many times, and it's very hard for people to get a job back into that same industry. Now, a lot of times you go off and do a fun job, right? Work at the Mountain Winery, have some concerts, right? I've got some people working at SAP, enjoying the concerts, the Sharks games, other things, So you could do a job for fun, something that you're interested in. There's lots of different options, but again, you got to keep those options open, and really figure out what's the best thing for you. But definitely, if you have that planning ahead of time and you're on track and you're on track, if something bad happens, you're going to be okay. Thank you for tuning in to Wealth Creator Radio. I'm Eric Heckman, and it's been a pleasure guiding you towards a more confident and secure retirement. Remember, my responsibility is to always do what's right for you, our client. Together, we can cut out that fancy-sounding financial jargon that doesn't help and focus on what truly matters for your financial future. If you're ready to take control of your retirement planning and build a personalized income plan, contact us at 800-454-1184 and text the word TOOLBOX to schedule a complimentary consultation. If you're looking for more resources and tools to build your retirement future, don't forget to check out that Wealth Creator Toolbox, your toolkit for a secure and confident retirement journey. Until next time, retire more and worry less with Wealth Creator Radio.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting, marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.